What is the state? How does it preserve itself? What does it fear? These are the questions Murray Rothbard uncovers in his powerful book, Anatomy of the State. Thanks to our generous donors, the Mises Institute is offering a free copy of this Rothbard classic to Human Action Podcast listeners. Get your copy at Mises.org/HAPod free. That's HA like human action, pod free. This is the Human Action Podcast, where we debunk the economic, political, and even cultural myths of the days. Here's your host, Dr. Bob Murphy.
Jonathan, welcome back to the Human Action Podcast.
Hi, Bob. Thanks for having me.
Well, what we're going to be doing today, folks, is going through, Jonathan has a recent Mises Wire article on the problems of the U.S. government's increasing debt load. And, all of us are familiar, I'm sure, with the general concept here, but just some of the charts Jonathan put into his article and some of the specific points he made show just how serious this is. And let me just mention before we dive into it, we won't require you to watch the video, so we'll verbally go through anything that you would need to know in case you're listening to the audio version of this episode. But if you are able to switch over to the YouTube, if you're not already watching the video, we'll be flashing some of these charts up here so you can follow along at home if you want to. So, Jonathan, why don't you take it away and just start walking us through your article and the points you were making?
Sure. In the article, I'm just looking at the size of government debt and how it's increasing way more than people anticipated. And that's due to the size of the deficits that the government is running. People wouldn't say that we're in a crisis year this year, yet we still have massively increasing deficits. And one problem that this is causing, especially for the Treasury, is that they're having to sell a lot of debt. And what I point out in the article, just to sort of give away the punchline, is that they're running out of buyers. So that they've run out of foreign governments and foreign central banks and foreign investors to sell their debt to. Even here in the U.S., they're running low on buyers. And so what that means is that the price of government bonds is decreasing and yields are increasing, which means that the amount that the government's going to have to pay as interest on all this debt is also increasing. So it's sizing up to be a pretty serious issue for the government. We talk a lot about how even over the past few decades, we've been talking about how the debt is increasing at alarming levels, and we're sort of like Chicken Little sometimes talking about how big the debt is. But it seems like this time it really is a serious issue for the Treasury, simply because they've got a ton of supply coming onto the market. They're going to have to sell a bunch of debt next year once the current debt matures, and also they're running into decreasing demand for their debt. So it's that combination of events is turning into a pretty big problem for the U.S. government.
Yeah, and just to underscore, so people near my age, and I'm only in my late 40s, I know I don't look a day over 55, but that's because I worry about things. Growing up, in the 80s, like I was into political stuff sooner than most kids. I was reading wonky things. I was more of a conservative when I first got into this stuff, and then only gradually realized, oh no, actually I'm a libertarian. But at the time, there were all these dire warnings from what nowadays would be called like deficit hawks, people like that. And it was right and left, by the way, at the time. And there were all these scary predictions showing how, hey, a couple decades from now, Social Security and Medicare, what they would just call unfunded liabilities, are going to really just become a goblin eating up the budget, because we're going to reach a point at which the incoming contributions, payroll contributions from workers coming out for their, FICA and so forth, that's not going to cover the outgoing benefit payments to retirees and the disabled and then on the Medicare side as well. Well, we already in Social Security crossed that Rubicon several years ago. All right, they didn't make much fanfare at the time because partly I think it originally happened during the financial crisis or soon thereafter. And so there was lots of other things to worry about. But Anyway, I'm just pointing out that when I was periodically reviewing the Social Security, actuary reports or the trustee report, whatever they call it, after the fact, and I realized that crossover had occurred, I didn't remember anybody talking about it. So I'm just saying, in case you were like me and you grew up with these scary projections showing, hey, at some point we better reform these entitlement programs or else, it's going to be cannibalizing the rest of the budget. We already there. That in terms of the collection, so they still on paper, because they have, for example, the Social Security Trust Fund, since that's still being whittled away on paper, it looks like the Social Security program isn't a net drain on the rest of the budget yet. But again, part of that just, however you want to deal with the accounting and whether you think that's a trick or not. But even on its own terms, that trust fund is rapidly being consumed. And so again, that's just one example of the kind of thing I mean, where Jonathan's saying a lot of us have been talking about these types of things for years, and there is this tendency for your eyes to glaze over and whatnot. But the numbers, like it's no longer something like, hey, we better get our ducks in a row or some crisis is going to hit 10 years from now. No, it's hitting now. Like we're already in the throes of this. So, Jonathan, should we maybe start with that CBO chart? I think that's a pretty good one.
Oh, sure. Yeah.
Okay, so folks, we'll flash this up on the screen. But yeah, Jonathan, you want to set this up and explain what this is?
So the CBO is the Congressional Budget Office, which is it's well known for not being partisan, not being biased one direction or the other. It's pretty good at giving a fair projection of the future, and it's showing that just the net interest payments that the U.S. government is going to have to make, it's going to make up a huge portion of the government's budgets going forward. So we're getting to the point where the debt that we've accumulated so far it's eating into the government's ability to spend on a year-to-year basis. And one additional problem with this is that tax revenues aren't keeping up. So I mean, we all hate taxes, and especially listeners of this show would probably agree that taxation is theft. But the idea is that tax revenues themselves aren't keeping up with the level of spending, which is further exacerbating the height of the deficits, or I should say the negative height of the deficits. And so if you look at this CBO chart, you'll see that the purple area shows just the normal or the primary deficit or surplus. In our case, it's a deficit. And then the teal shows how much of that is interest. So the net interest outlays, it looks like, just 5 years from now, it's going to turn into half of the budget. So half of the budget is just going to go towards paying interest on previous debts, on debts that were incurred by all of the spending that happened earlier. And so this doesn't look like it's a solvable problem. It looks like this is something that's just going to get worse and worse. We could go into a debt spiral in which the government is going to have to keep taking on additional debt, so borrow even more just to pay interest on the existing debt, and which will further exacerbate deficits, which means that the debt problem is just going to get worse and worse. So it's looking like Ryan McMakin is right. He also had a recent article on this issue, and he was explaining how there's not an easy way out of this problem. And I've come to the same conclusion here, that it doesn't look like there's a way for the government to get out of this. I mean, except by dramatically reducing spending. So like they would have to do some pretty severe cuts to their spending. I mean, eliminating whole agencies, which I mean, I would be a cheerleader for that. But I don't think that sort of situation is very likely. And so what it looks like is that all of this interest that we're going to have to pay is going to take up a huge chunk of deficits going forward.
Yeah, and let me just say the same type of thing, but in different words, just to make sure the folks at home are getting this. So again, if we flash that chart up. So like Jonathan was saying, it's important to understand the distinction, not just the magnitude of this, downward movement along the y-axis there, but also to look at the composition in terms of the color coding. So you can see, for example, and what this is measuring, it's the federal budget deficit as a percentage of GDP. Okay, so this isn't just like, if you charted the debt or the deficit in terms of dollars, it would go up over time, but that's because the economy would get bigger, and you think, okay, that's not really. But this again is just saying as a share of the total size of the economy, and you can see where it goes way down back in 1943, and that's because of World War II. Okay, but where it's roughly eyeballing at just 30% of GDP at that point. Okay, so that was the biggest on record in terms of the size of the deficit compared to the annual output. But you can see that. Back during the financial crisis, 2008, 2009, the deficit got to around 10% of GDP. And then briefly during COVID, it got even lower than that. So in between, again, eyeballing, looks like it's getting close to about negative 15%, relative to the size of the economy. But notice the difference. And then in the long-term projections, so this projection by the CBO goes out to 2053, so a 30-year projection. But notice that it gradually drifts larger and larger, the projected size of the federal budget deficit relative to the economy, such that by 2053, it's in the neighborhood, again, of about 10% of GDP. But again, look at the composition. You can see for all those earlier crises in World War II, the financial crisis, and then with COVID, the line was mostly filled up by the purple. And again, that's the primary deficit or surplus. So what that means and the way they score these things is that, like, looking at specific spending programs, whether it's the military or relief, unemployment insurance, whatnot, Medicare, Medicaid, Social Security, flowing payments, that's what they mean relative to tax revenue. Whereas the net interest outlays, they separate that out, right? So they're trying to show, in any given year, if there's a deficit, how much is due to current spending and revenue realities versus what's just kind of a legacy from the accumulated deficits of the past, which right now are showing up in terms of interest payments on that accumulated debt. Okay, so that's the distinction between those colors. So you can see, as Jonathan said, over time, that teal just absorbs a larger and larger amount of the growing magnitude of the federal deficit. And so specifically, by the 2053, at the end of this forecast period or this horizon, I'm just eyeballing it, but it looks like well over 2/3 of the budget deficit is just due to the interest that is owed on the previously accumulated debt. All right, so that's, again, just showing how much they're painting themselves into a corner, as Jonathan's saying, that, again, eyeballing, it looks like roughly 5% of GDP there is just going to be paying interest on the accumulated debt. So in other words, they're borrowing more money at that point just to keep paying the interest they owe on the previous amount. And then that's just in turn racking up more debt going into the next period. All right.
And one thing that the CBO hasn't forecasted, and I'm not even sure that they could do this, is they haven't forecasted any crises going into the future.
Right.
But if you look at that line, if you look at the deficits over time as a percent of GDP, you'll notice that it's a zigzag. So like there are some times where times are good and tax revenues increase because people's incomes are increasing. Maybe there's a slight decrease in the increase of government spending, something along those lines, which allows deficits to get a little less worse. And there was like a brief time in the 90s where we had budget surpluses. But then you can also see very obviously, like Bob was saying, you could see World War II. And so like there was a huge increase in the deficit simply because of the amount of spending that was going on. And then you can also see other crisis periods. Like you can see the 2008 crisis. You can see the COVID crisis where the government spent a ton of money. But one thing that you don't see going into the future is you don't see a zigzag line. So the CBO is sort of like taken whatever the existing proportions are, and they sort of forecast it out, but it looks very smooth. They're not taking into account other crises that definitely will happen. And I think soon, so like even next year, we could have another big increase in government spending if there's a recession, and if not next year, then sometime soon. And so what that would do is that would increase the deficit even more. So it seems like even though the CBO estimates and the forecasts are fair, they don't lean one direction or the other in terms of like Republican versus Democrat. One thing that they are sort of biased towards is normalcy. So they're biased towards there not being a big crisis where the government has to unexpectedly increase its spending. And so if anything, these projections will just get worse.
Right. And I'm glad you brought that up, because I was going to underscore that as well, that the assumptions they make behind these charts, they're just forecasting sort of run of the mill, like, yep, if everything kind of stays the same and we just have normal, things, and specifically, so what's driving, why do things get so bad over time? They're merely showing interest rates reverting back towards more historical norms, in other words. So as Jonathan's saying, this is not at all forecast a crisis. They just assume economic growth returns to what they now think is, the new long-term normal average and so forth. And it's just, so I guess another way of putting it is the reason they were able to get by so long with those primary deficits being so big, and then that not showing up in a growing amount of area being taken up by the teal section with interest payments, is because for the last 10 years or whatever, interest rates have been at rock bottom levels, especially on treasuries. And so it's, sort of like they were in the honeymoon period when you keep getting 0% balance transfer offers on your credit cards, but now rates are resetting. And that goes into what you were saying there, Jonathan. Do you want to maybe just spell out the specifics about how you mentioned there's a big chunk of debt that's coming due next year?
Mm-hmm. So all of this is happening while there's declining demand for U.S. government debt. And this has really become apparent this year, although we've sort of seen this as a tendency over the past few years. But as you pointed out in your talk at Fort Myers, you showed this graph, and maybe we could show it for the viewers here, of the federal debt held by foreign and international investors as a proportion of all federal debt held by the public. And you could see that since about 2014, it's been declining, and pretty steadily and pretty sharply. And so there's this decreased demand for debt. There's decreased demand for debt by foreigners, but also here in the United States. And this is all coming to a point where, as you said, next year we're supposed to see a big chunk, about $7.6 trillion worth of U.S. federal government maturing. And so if the government wants to maintain its level of spending this year or increase it, it'll probably increase it, then that means it's going to have to roll over that debt, which means that there's going to be a bunch of new debt offered on the market. So the Treasury will announce these auctions saying that we're going to try to sell this many Treasury securities, and they'll have different maturities that they'll put out there. And they'll just try to see what are people willing to pay for this. And what we've noticed in October and this month as well is that the yields on these Treasury securities are higher than the Treasury has expected, which means that there's not as much demand as they were expecting. So there's not as much demand, and there's about to be a lot of supply coming on the market next year as the debt rolls over. And so maybe we can talk about how is the U.S. Treasury going to navigate this, where they have a bunch of new debt to sell, but it seems like not a lot of people are ready to buy it.
Yeah, and specifically, do you want to just elaborate, Jonathan, on you have a bit in your article here talking about in October how there was a Treasury auction that some people were referring to it as it failed, and because the primary dealers had to come in. Can you just explain what people mean by that and just give the listener some context?
Sure. So what happened is there was an auction. I think it was of 30-year yields, but there were a couple other auctions during October that had the same sort of features where the yields were a lot higher than expected, which means in common parlance that people are not willing to pay a high price. So like the prices that people are willing to pay for this government debt are lower than the Treasury wants or expects. And what happens at these auctions is everybody takes a stab. Everybody, makes their bids for how much debt they want to purchase from the U.S. government. And then at the end, the primary dealers are forced by their position as a primary dealer to buy up any of the remainder. So like they have to buy whatever is left over at the end of this auction. So everybody else gets to say how much they want to buy, and then the primary dealers have to buy it. And this year, the average has been about 11 or 13% of the auction has had to go to the primary dealers because that's just how much was left over. But what we saw in this October auction is that it spiked up to about 18%. And I've just seen some recent headlines showing that it's getting up to like 19 and close to 20% of the auctioned amount is having to be bought by the primary dealers. And so what that means is like they're forced to buy it. And what it means is that there's not much demand for these treasuries. It's somebody trying to sell something, but they've run out of buyers, and the only people who are willing to buy what they've brought to market are the people who are forced to do it. So that's why those auctions are being called a failure.
Right. And the truism here, folks, in case you're getting lost in what you're saying, remember, when it comes to fixed income securities like bonds, if the price goes, for a given promise of cash flows over time, including the return of the principal, if the current market price goes down, then that implies a higher yield, right? Because you have to pay less to get the thing in the beginning, and then the money coming in that you're promised contractually will work out to a higher yield on the bond. And so the point being that Treasury, when it went into these auctions, made some estimates about, we got to raise $20 billion worth on this particular auction of 30-year treasuries that we're newly issuing, and we expect to get this kind of yield, and so we'll get this sort of demand, and so the demand's just not there for it. That people did not want to absorb $20 billion worth at that point at that yield, and so people offered less, meaning the implied yield was higher than the Treasury thought they were going to have to agree to. And then, some of the slack is being made up by these primary dealers who, by their very nature, to get their privileged position, it's understood that, you guys mop up the mess in case there's insufficient demand. Also, too, Jonathan, so you already hit on the fact that the proportion of outstanding debt held by the public, Treasury debt held by the public, the proportion being held by foreigners, that peaked in 2014 has been falling pretty rapidly. Mm-hmm. And what's happening there, folks, just so you understand the underlying realities, it's not that foreigners are dumping treasuries, although the Chinese are actually reducing their holdings, but rather what that figure is reflecting is that foreigners were not absorbing net new amounts of U.S. debt very much since 2014, at a time when the U.S. government, the Treasury, was issuing a lot more debt. So that's why the proportion of the total amount held by foreigners started, falling like a stone after 2014. But also what you pointed out in your article that was interesting, Jonathan, and, I guess I knew this, of course, but I wasn't putting two and two together necessarily the way you presented it, was you just have a chart showing the amount of treasuries held on the Fed's balance sheet. Mm-hmm. So a lot of times we just show like the Fed's total assets, or that's what I do. But you kind of stripped out the mortgage-backed securities and everything just to isolate and show the Fed's holdings. So maybe we can flash that chart showing the Fed's holdings just of Treasury securities, and you can see that thing has been dropping pretty steadily as well. Mm-hmm. And so I don't know if you want to comment on that.
Sure, Jonathan. Yeah. So I'm just trying to show that all of the usual buyers of government debt are falling by the wayside. So as the previous chart showed, foreigners are not buying as much U.S. government debt as before. But another major buyer of U.S. government debt is the U.S. government's money printer itself. So the Federal Reserve owned almost, 6 trillion, millions? Is that right?
Yeah.
Yeah, $6 trillion of U.S. Treasury securities. And that was at the peak, but now that they've started this quantitative tightening, where they're trying to increase interest rates, they're trying to step on the brake pedal, trying to get price inflation under control. They've had to reduce the amount of government debt that they're holding. So this is at the same time that people around the world are reducing their demand for U.S. government debt, and so it just shows that all of the people who the Treasury used to be able to rely on to buy their debt, and when interest rates were very low, they're now running out of those buyers, and interest rates are increasing. And I know that's all connected. Like, a part of the reason why interest rates are increasing is because the Fed is reducing how much it's purchasing, But it just goes to show that this has turned into a real crisis for the Treasury, because they can't even rely on the Federal Reserve to buy their debt at this point. Now that could change next year, although it's difficult to see how the Fed would be able to do that unless they are able to like convincingly show that they've gotten price inflation down to their target. But they won't be able to resume their massive purchases of assets, including Treasury securities, until they've got the price inflation narrative under control. I won't say price inflation, but at least the narrative under control, because right now they're constrained by the bad press of price inflation.
Right, and just to explain it from a different angle, to see I keep using this metaphor, the corner they painted themselves into, as Jonathan is saying, because the Fed. You could say, well, I don't care about primary, the primary dealers can just keep buying it and mopping it up, because ultimately if foreigners don't want to hold it, even if domestic citizens in the private sector don't want to hold it either themselves in terms of households, or, more typically their 401ks or whatever, their portfolios will contain a lot of treasuries, it's the risk-free asset, right? But even as that appetite dwindles, still, hey, you've got the Federal Reserve, at least since 1971, there's really no constraints, but there still is the constraint of the public being mad about everything getting so expensive. And so it's sort of like just a return to reality, because there was a period following 2008, when guys like me were saying, whoa, this quantitative easing stuff, this is opening up Pandora's box here. The dollar's going to get hit pretty hard. And then that didn't seem to happen for a while. And, we won't take the time now to go over some of the reasons as to why that may be the case. But clearly, from COVID forward, things seem to play out the way that you would teach in a standard macro class or money and banking class, where, hey, if they open up the monetary spigots and the federal government runs massive budget deficits as far as the eye can see, then you see consumer prices rising pretty rapidly. And so how do you deal with that? How do you contain that? The Fed has to tighten. And so it's a combination of raising interest rates and, of course, letting its own balance sheet roll off, which has the effect of sucking reserves out of the system and kind of extinguishing some of that money that it pumped in during the rounds of QE, and then particularly during the COVID crisis. So again, yes, they have the legal authority. They could just effectively create the dollars to buy any new bonds that the Treasury feels like issuing, and it's just kind of a big shell game going through the primary dealers if they need to. But they are being constrained, that it's going to be harder for them to get away with doing that if price inflation starts running hot again. And because even though everyone's been running victory laps, the victory lap isn't that, even using their own cooked numbers, it's not that the Fed right now is within the parameters that it said it wants to be in terms of, this is our preferred level of price inflation and with our preferred metric. It hasn't gotten there yet. The reason everyone's running victory laps who are doing so is because they're saying, oh, wow, it's amazing how much we brought down, they use the term inflation, without unemployment zooming up. Mm-hmm. Okay, but nobody is agreeing that right now price inflation is where the Fed thinks it should be. It's just they're so happy. Look at the progress we've made, but it still should, according to their own guidance given to the public and whatnot in markets, it still needs to come down. So the Fed, as Jonathan says, they can't just turn on a dime and just open up the monetary spigots, at least not before a major crisis hits. So that's kind of the idea that we're saying we think a crisis is coming because you've got all these, runaway trains going down, and something's going to give pretty soon, one way or the other.
So that's what I talk about in one of the scenarios. So I'm trying to do my own bit of forecasting here. I'm trying to think about what happens if there's a crisis next year, and the Fed does have to go back to its usual game of expansionary monetary policy. And I think that I think they risk sending the U.S. into the 1970s style stagflation. So like inflation is already a problem, despite what everybody is saying that the Fed has solved, like they've achieved the soft landing, inflation has come down. I still think that price inflation is still a problem for the Fed. And if that continues to be a problem for the Fed, and then we have a crisis where the Fed has to increase the money supply and push interest rates down and stimulate consumption spending and investment spending across the board, then I think we could see the 1970s problem come back, and so that's where I mentioned in the article that we could see a stagflation. And you've already used the metaphor of painting themselves into a corner. This is yet another way that the Federal Reserve has painted themselves into a corner, because if they're following the Phillips curve framework, and if they're trying to achieve the so-called dual mandate, where they're trying to keep prices stable and maximize employment, but if they're thinking in the Phillips curve framework, it means that they don't really have a direction to go. It means that if they're contractionary, then they're going to not address the unemployment problem. But if they're expansionary, then they might increase employment, but they'll also increase price inflation at the same time. And so it's a tough spot for both the Treasury and for the Federal Reserve if that happens. And I do think a crisis will happen.
One of these particular scenarios that you were sketching out is you were bringing up the idea of a soft default. Can you just speak a little bit about what that is?
Yeah. So in the past, when the government and the Federal Reserve has been painted in a corner like this, where it seems like they don't really have a direction to go, they do what's called a soft default, where they don't stop making payments on their bonds. They don't stop giving the coupon payments to the bondholders. But what they do is they do something dramatic to the U.S. dollar itself. They redefine the dollar in a certain way, or change other contracts that they've other promises that they've made in the past, such that it sort of helps them squeeze themselves out of the problem. And one example that I gave is in the 1930s, when the government redefined the relationship between gold and the U.S. dollar. So it was $20.67 per ounce, but then they redefined it to $35 per ounce. So they did this devaluation of the currency. So they were still able to make their payments in dollars, but now those dollars were redeemable for less gold than before. And similarly, but also differently, in the 70s, Nixon famously got us out of the Bretton Woods Agreement, which meant that the dollar was not even convertible for gold for other governments. So citizens at that point were not able to redeem their dollars for gold, but foreign governments were able to, and there was this gold drain happening. So the U.S. was losing a bunch of gold because they were inflating the supply of dollars. And so what Nixon did was he just got rid of that agreement. He got rid of that promise to foreign governments and foreign central banks to redeem dollars for gold. So it was a redefinition of what a dollar is that allowed the U.S. government to escape the sort of problem that it was suffering at the time, both in the 1930s and in the 1970s. And so one idea that I thought of as a way that the government could continue this pattern of the soft defaults is by implementing a central bank digital currency. So with a central bank digital currency, they could use negative interest rates, and they could use other incentives built into the dollar itself that would increase demand for government debt, that would give them more control over interest rates, that would give them more control over spending broadly. And so all of that extra control, which would be afforded to them by basically putting the dollar into a new category. Now it's not a paper fiat anymore, but it would be the central bank digital currency. All of that would allow them to sort of wiggle themselves out of this problem that they put themselves in.
Yeah, I was trying to think of some other mechanisms they could use too. I didn't look up to see how big of a proportion this is, but I know there's Treasury inflation protected securities, or TIPS. And so, they could cheat on that margin too by just messing with the definition, if it's tied to the CPI or so, they could lean on the people who crank those numbers out, and maybe even if it's just a few percentage, a few basis points or something, but over the long term, and with how many hundreds of billions they may have had in those types of securities, they could save some money that way, which technically would be because they're violating the spirit of the contract that they have with those lenders. Also, another avenue they have, I know my co-author Carlos Lara, a few years ago, he did a lot of research looking into how the Fed and other related agencies were implementing some of the stuff coming out of the Basel Accords. And basically the spirit of it being that, the government could change regulatory requirements in the name of, we want to shore up our financial sector to make sure like the too big to fail institutions have adequate capital safeguards and blah, blah, blah. And basically incentivizing and or forcing major institutions domestically to hire or to carry more treasuries on their books. Like, in other words, like to tighten the screws in terms of, you got to show that this percentage of your portfolio is tier one capital, and and what qualifies for that? Really safe things like, U.S. Treasuries, for example, right? So there was a way that the thinking being that, this is certainly what Carlos was making the case for, and I thought it was plausible at the time, just to show that they looked like they were getting themselves into a position to be able to require through regulatory means that U.S.-based institutions started holding a lot more treasuries on their books than they wanted to, without such prodding. And so that, again, just other kinds of ways where they could use coercion to somewhat minimize the problem that is now starting to rear its ugly head.
Yeah, one wild card along those lines is the rating agencies. So I've seen some headlines over the past couple of years where U.S. government debt has been downgraded, and I wonder if in those downgrades it would actually have an effect on those capital requirements that you're talking about for banks, or maybe it's not even close for them to go from one tier to the next.
Yes, I don't know the specifics off the top of my head, but certainly in principle, if they got downgraded enough, then if all of a sudden Moody's and S&P said, you know what, treasuries are junk bonds, then that would have an effect. So yeah, that's not going to happen next Thursday, of course. But one thing I will just mention, though, I don't know why people think like this, but I've had occasionally when I bring up these sorts of issues, like on Twitter or whatever, I'll get some pushback from people who are not progressive fans of Joe Biden. They're hard-headed, hard money people, gold bugs often. But for whatever reason, they think I'm being goofy and that, no, don't I understand that they've got a printing press and, where else are people going to go? That the dollar is it. And I don't, it doesn't have to be the case that the world's global reserve currency switches away from the dollar and everybody goes into the euro or the yuan or something. Like, that doesn't need to be the case for there to be a collapse in the demand for the U.S. dollar / treasuries. Mm-hmm. That it could be that people just want to diversify away and go more into commodities or something. All right. So it's, even though we talk about the treasuries being like the risk-free asset held by investors around the world, there doesn't have to be such an asset. I mean, there needs to be it if you're reading textbooks issued by the Chicago School and you want to go look at, the CAPM model. But it doesn't mean that in reality there has to be something that all the investors say, I can't conceive of a scenario where this entity might default on this. That no, there's no reason to suppose if the Treasury keeps this up, there's no way it's going to maintain its current ratings. It's just that we're going to see over time that it's going to become more and more unlikely.
Right, and hopefully that doesn't turn into like draconian taxes. So like one thing that the government could turn to, if it doesn't want to decrease its spending, is use something like a CBDC to just impose really high tax rates and use that to finance its exorbitant spending. So yeah, one thing that I mentioned in the article, and I mentioned in recent talks, is that there's a lot of uncertainty surrounding all this as to like what direction things are going to go. And a lot of the uncertainty has to do with the fact that institutions like the Treasury and the Fed have done crazy, unprecedented things before, even in the past couple of decades. And so there's really no telling what the Fed will do, not just in like what quantities, like how much more will it expand, how many more treasuries will the Federal Reserve buy, but also like what sort of thing will the Fed be going into the future? And I think a lot of people have that sort of uncertainty, which makes this sort of forecasting of like what would it look like for the U.S. government to default on its debt, or what would it look like for the U.S. government to get into this severe debt crisis? It makes making all those sorts of guesses tough.
Right, and just one final note on the CBO and their modeling and such. Like Jonathan said, it's like people throw around terms, it's nonpartisan. They really are. and I can't say the person's name because I don't know if I should, but several years ago, the person who was like running their modeling when it came to carbon taxes and things like that, that person would periodically reach out to me and just say, hey, you know, we're working on this, like what kind of article should we look at or whatever. Like, not because they thought that they wanted to encapsulate my view as what they were going to do, but just the person wanted to make sure they were familiar with all the different schools of thought on a certain issue, that they had their bases covered, right? So they would go ahead and present whatever the, you know, middle of the road analysis was, but then they might in a footnote say, you know, some people, however, quibble and say blah, blah, blah. You know, anyway, so I'm just saying that they really are trying to be neutral. The reason the figures like can end up looking crazy or being very misleading compared to reality is that they do what they're told. They're sort of like a computer that, hey, if you program the computer to do this and you give it the wrong instructions, then garbage comes out. It's the same thing here where the CBO economists, they do exactly what they're tasked with. And so if they're told, oh, go make a baseline forecast, and if we put in, you know, if the way we got this to be scored at costing less than such and such over a 10-year period was because we put in all kinds of really implausible budget cuts 9 years out, and that's how we're... Go ahead and model that as if we're going to do what we all know 9 years from now we're not going to have the political will to do. And also, don't assume there's any recessions or whatever, because how could you forecast that? Just do a baseline, and then if there's a recession, that'll be a deviate. But so that's what they went ahead and did. But especially if you're an Austrian, you're thinking there's going to be a recession in the next 5 years, right? Probably a really bad one. And that's going to make government spending go up, and it's going to make tax revenues plunge. And so these forecasts, even though it's considered like a baseline or whatever, it's more like a rosy scenario as far as I'm concerned. Any final thoughts, Jonathan?
Oh, the way I concluded the article was that the government got itself into this mess, and no matter what happens, we can be sure that they're going to do the wrong thing.
Yes, so a prediction made with utter confidence coming from Jonathan Newman. They say the Austrians aren't willing to be pinned down on something. Well, there, you heard it here first. That's what's going to happen. Well, thanks, Jonathan, again for your time and insights. And folks, check out Jonathan's article at Mises Wire on this topic. We'll link to it all at the show notes page. Thanks again, Jonathan.
Thanks for having me, Bob.
And thank you, everyone, for tuning in. We'll see you next time.
Check back next week for a new episode of the Human Action Podcast. In the meantime, you can find more content like this on Mises.org.